Today, we're going to be focusing on gold. An article on Nasdaq.com written by Arundhati Sarkar had this to say. Gold prices edged higher on Thursday due to slight pullback in the US dollar, although higher treasury yields and prospects of more sharp rate hikes by the Federal Reserve kept gains in check. Spot gold rose 0.2% to $1,631.54 per ounce, and gold futures inched 0.1% higher to $1,636.50. The dollar index was down 0.1% against its rivals, making gold less expensive for other currency holders. Peter Vertig, an analyst at Quantitative Commodity Research, says, quote, "A slightly weaker US dollar and losses in the equity markets are giving a little bit of support to gold as a safe haven." Now let's take a look at gold inside of our EdgeFinder software. So here we are inside of the EdgeFinder on the gold page. Keep in mind that this is gold against the US dollar. We're not looking at gold against any other currency but the US dollar. That's why when you look over here and we look at fundamentals, we see numbers for the US dollar as well as sentiment. We have our COT data, institutional trader data. We see gold, but we also see US dollar. So this is XAU USD that we're looking at.
Want access to our free FOREX course? Fill out the form in the description below to get access for free today. Read up on technical strategies, fundamental analysis, and risk management tips our team uses here at A1 Trading. Be on the lookout for an email from one of our team members with access to the free course.
Strong sell bias here, score of -7, seeing lots of red boxes down here. And we'll go ahead and go through all of these boxes with you. So COT data starts off with a neutral score, 0, and we can look over here. Again, US dollar, 78.57% long and 21.43% short with institutional traders. And gold is also favored on the long side, 64.28% long and 35.72% short for gold. So institutional traders long on gold, but even longer on the US dollar. Retail sentiment, retail traders are long on the pair as well, long on gold as well, 62% compared to 38% short, and that gives us a score of -1. If you're wondering why these things are scored the way they are, we have our scanner output summary down here towards the bottom of the screen, and this is a written summary of all of the data that you see here. So these are the numbers explained out, so we can actually look and see, for example, taking a look at seasonality, we get a score of -1, which tells us based on historical data, this market tends to fall during this month. So seasonality, -1 score. Here are our numbers for October. But historically speaking, looking into the later months of the year, we see an upward trend. But we have the score of -1 because historically this market tends to fall during this month, which is consistent with what we see here when looking at the September numbers. So we have our all-time average and our last 5-year average here. And all-time and last 5 years, we can see a slight dip from September to October. So that score of -1 there makes sense. Trend reading is -2, and that just means that this market is moving down respectively. GDP growth gets a score of 0, and again, we're just taking a look at US dollar here when we're talking about fundamentals. So GDP growth, 0, nothing really to compare it to, but we can just take a look at the numbers for the US dollar anyway. So US dollar GDP, -0.6%, unemployment, 3.5%, inflation, 8.2%, and interest rates, 3.25%. And then here we also have our daily price chart. So here the daily price chart, this is showing you the daily average price for the past 2 weeks or so, as well as price forecast predictions. And this is a really cool feature, one of our newer features here in the EdgeFinder. This price forecast prediction takes into account all of this data that we're keeping track of in the EdgeFinder, and then makes educated analysis, educated guesses for where price could potentially move to based on a few different things. So for example, moving into tomorrow, October 21st, if we were to see gold start to perform better, this green line here is some price points that we could potentially see gold being around. If it kind of stays neutral and keeps doing what it's doing, we're looking at this orange line here. And if gold drops even further than it already has, this red line here are some price points that we could potentially see gold being around. Not these numbers exactly, but these around these numbers here, so you have an idea of which way the market is moving. So that was a quick look into gold here in the EdgeFinder. Remember, if you want the EdgeFinder for yourself, you can find that in the link in the description down below. We also have a link for free trial access to the EdgeFinder. You can actually try out the EdgeFinder for a day or two, 100% free, to decide whether or not this is something that you think would help you in your trading. And so try it out if that's something you'd be interested in. Now let's hand it over to Trader Nick with highlights from today's stream.
Now, I want to take a look now at gold here in reference to our dollar idea. Let's discuss gold here. First, we'll take a look at a price action standpoint, and then we'll talk a little fundamentals on the gold market. People asking, why is gold so incredibly weak? Well, I'll have the reason for you in just a moment, or at least my opinion on everything as we speak. So first of all, moving averages, we're looking at the 1 hour chart. The 1 hour chart looks bearish. The 4 hour chart looks bearish. And the daily chart looks exceptionally bearish, okay? Gold here cannot seem to find a bid, and it's an incredibly consistent downtrend at the time of making this. So, what's the reasoning here for it? And technically, where's the sell setups? Well, again, if you're just going off technicals, I think you might get opportunities to sell this thing on a rally. So if you do see a bit of a bounce off of this low, for me, I'm taking any rally as an opportunity to be more short bias. And here's why. Longer term, super long term, gold might do just fine. But in the short term, it's got a lot of momentum to the downside. If we draw some fibs here from the swing high to the swing low, this is a daily chart. Now, if we zoom in a little bit on the 4 hour, you start getting some interest here at the 38.2% retracement. In my opinion, I think that's a decent spot to look for pullback opportunities, looking to go short primarily on the gold market, with the idea that, yes, we're sitting at support. But remember, support in a downtrend eventually will get broken if the trend is going to continue, right? So if we know, hey, likely the gold market is going to continue to trend lower, it's not a guarantee, but it's a good solid chance, right? Any rally up to the 38.2% retracement, right, to me is an opportunity to look at gold and say, hey, you know what? Let's take it for what it is. It looks bearish. Not only is it trending from a technical standpoint to the downside and looking bearish in that regard, for me, gold fundamentally is incredibly bearish for now. And here's why. You have to analyze gold on a couple different perspectives. If you're talking about the gold market relative to the dollar looks way attractive, right? We've discussed this many times, but gold being countered against the dollar, right? We are literally crossing the gold market versus the US dollar. And if the dollar is incredibly strong, what's that going to do? If the dollar is strong, it's going to put pressure on the gold market coming down, right? So that's number one. The dollar is incredibly bullish. Why? Because the Federal Reserve, as we mentioned earlier, has maintained a very hawkish stance, trying to get that inflation figure down, right? What are they going to do to get that inflation number down? They're going to raise interest rates. And that brings me to a very important topic when discussing gold that many of you guys may not have even ever heard about or thought about, which is, of course, the bond yields. Okay, now, this is some deep fundamentals for you, but let me show you this. This is what is considered the U.S. 2-year yield. Now, bonds are not something we talk about often on the channel, but if you're going to be trading gold, if you're a fundamental trader as well as a technical chartist, it might be worth your while to understand what we're about to discuss. This is the 2-year yield curve, and this matters because when this figure is rising, this is essentially the risk-free option to investing. It's the closest thing to risk-free that you're going to get in markets. What you're saying is, I will lend the government money for 2 years, and this is how much I get. So right now, this number is rising dramatically. If this number goes higher, What this means is that people look to gold as like a safe haven investment, right? But this is also a safe haven investment. And the difference here is that when this number is screaming to the upside, why would you buy gold when you could get risk-free 4.6% per year? As this thing rises with the dollar, with that story that continues to go higher, the gold market gets crushed, okay? And that is because gold and this thing are rivals. So oftentimes, I've talked about this on my channel before. A while back, I talked about it a lot more. Gold versus bonds, okay? This is the story that you guys need to think about. The big people, a lot of people who are investing in gold, they have an option in front of them. They're looking for a low risk investment. That's why people buy gold long term. But bonds are the same asset idea. It's low risk assets where you get a return. Right now, bonds look way more attractive than gold. So the money is not going to gold, it's going to bonds, right? So this is a fundamentalist idea. But when yield curves are so rocket high compared to where they were, if they're looking more attractive, I mean, imagine if you could get risk-free 4.6% per year, essentially, by buying bonds, a low risk asset. Or do you want to buy gold, which yields you nothing per year and could continue to sink lower as interest rates continue to go higher and higher? This is what you have to think about as a fundamentalist. Now, as a chartist, it also marries up. You've got a strong downtrend on the gold market, and any rally, in my opinion, is a sell, both fundamentally and technically, until further notice. Okay? So there you go, a little bit of fundamentals there for gold. Like I mentioned, a rally back up into the 38.2 to me is a sell. And also another sell would be if price were to break out and retest this area at 1622. If you get a break of this low, if this low gets taken out, you might get an opportunity to come back and buy it. Sell it into next week, right? Yes, the market is quite sold off, and you might say, well, isn't it a good time to buy? But remember, we just talked about the fundamentals, and this thing could trend much lower in the coming days, weeks, and months. Now, when that changes, when those fundamentals change, maybe when the yield curve gives off and it cools off, you might get some great value on the gold market where you could possibly ride it back up. But I'm not going to try and call that bottom because I think that's a tough one to call. For me, I'm a trend follower. I follow what the market's doing. And if it goes, if it's trending down, I'm looking for sell setups. If it's trending up, both fundamentally and technically, I'm looking for longs. And so when we look at gold, this is a market I want to be short on, not long.
Make sure you guys check out the links in the description if you need broker recommendations, access to our free Discord, or want to chat with us on Telegram. If you're interested in our trading software, the EdgeFinder, you can find that in the description as well. Thanks for watching.